Welcome to the short executive knowledge lecture on topic 5, paper 8 of the SFC licensing exams. This topic covers stock market administration, and we'll be looking at the trading systems, transaction costs, trading records management, the conduct of business, risk management, and influences of technology on the trading systems. I will emphasize the important points to help you understand the core material you need to know to sit the exam, and a copy of these study notes that you see on the screen can be downloaded from the Executive Knowledge website under Paper 8 Resources. Now, as ever, I strongly recommend that you supplement this learning with question practice, and we have many Paper 8 questions that are provided on the Examinator.online platform. Okay, let's get into the topic 5 material. So the trading system in Hong Kong, right at the top, page 2, all securities traded in the stock exchange must be executed through the Orion trading platform. Orion trading platform is only accessible to exchange participants, and that is worth a question on its own. So be aware, if you're an exchange participant, you get direct access to the Orion trading platform. Now we have some notes on the trading platform. When placing an order, you must provide an account number, stock name and code, quantity to be bought or sold, and the price limit. And we're told the orders are placed by telephone, mobile, or internet. Now, trading procedures for the cash market. Well, there's a pre-opening session from 9 to 9:30 and a continuous trading session which starts 9:30 and goes on to 4 p.m. And we have a closing auction session from 4 to 10 past 4. The types of orders. Well, the first two types that you can see go through the pre-opening session, or rather placed during the pre-opening session, and that is the at-auction order and the at-auction limit order. If an at-auction order is filled, great, but unfilled orders are automatically cancelled, whereas with an at-auction limit order, if it's not filled, it will then carry on into the continuous trading session. During the continuous trading session, we have limit orders where you specify the price. We also have market orders where you ask the broker to get the best price, but this is not in, for some reason, the paper 8 material. Enhanced limit order and special limit order. Now, the type of questions that are looking at the orders, they'll say which orders go in during the pre-opening session or during the continuous trading session, and they're looking for understanding of which orders go through which sessions. We have quotation rules that are listed there. I wouldn't be too excited about those. We have the closing price being 5, the median figure of 5 nominal prices recorded in the last minute of trading. Now, the volatility control mechanism, which was launched in 2016, is to protect the market from flash crashes, algorithmic errors, etc. And how it operates is if a stock price deviates by more than 10% from the reference price, and that's the price traded in the last 5 minutes, it will trigger a cooling off period. And that cooling off period, when there are limitations on trading, is for 5 minutes. Okay, Stock Connect. Now we have two Stock Connects. We have the Shanghai Stock Connect and the Shenzhen Stock Connect. And we've provided you with a lot of background notes. The points I want to highlight, well, the 4th bullet point, home market rules apply to all trades. So if you are trading in Hong Kong, it's the Hong Kong market rules that apply. If you're trading through the Stock Connect to Shanghai or to Shenzhen, it is the Shanghai or Shenzhen rules that apply, and that has been examined. Okay, on page 4, we have details of eligible shares that can be traded through the northbound link and the eligible shares through the southbound link. There are daily quotas for trading on both the northbound and southbound links, and we've given the daily quotas currently 52 billion renminbi for the northbound link and 42 billion renminbi for the southbound. They may examine the actual amount of the quota, but it's more likely the fact that they do exist. Now, the daily quotas are calculated on a net buy basis. What that means is, as the next point says, sell trades increase the available quota. It's the buy trades that use up the quota on a daily basis. So you take the day's buy trades minus the sell trades, and that will give you the available quota for the day, assuming it's below the 2 daily quotas. Okay. The last point on page 4 is worth highlighting. Southbound executed trades are settled on the usual T+2 basis. Now, we'll see that in a later section with regard to settle, clearing, and settlements. Southbound executed T+2, that's the Hong Kong regulations. Northbound, on the other hand, when you're trading through Shenzhen and Shanghai, it's T. You settle the stock trade on the trading day. And it's T+1 for cash settlement, which traders don't like the T settlement day for northbound stock trades. Right at the top, page 5, we're told that we have an investor identification model for northbound trading, and the exchange participants offer northbound trading services that offer northbound trading service must assign a unique number known as the broker to client assigned number BCAN to each of their northbound trading clients. Trading mechanism for derivatives, as we'll see, it's HKSI. The open outcry system ceased in the year 2000. So we now go on to the clearing and settlement system in Hong Kong. And I'm going to talk through this diagram on page 6. It's very important. The picture is worth 1,000 words, etc., etc. Now, at the top, we have the holding company, the listed company, Hong Kong Exchanges and Clearing Limited, and that's a recognized exchange controller. Now, it owns 100% all the entities below it. The stock exchange, the futures exchange. The stock exchange operates the Orion trading platform. Once a stock trade is matched in the Orion trading platform, it is passed on to CCAS, the Central Clearing and Settlement System, which is operated by the Hong Kong Securities Clearing Company, the Securities Clearing House. If it's a futures trade, you go down the right-hand side. Paper 8 is a paper on securities, so we don't have to worry too much about the details of the futures trades. But if you're dealing with traded options, which is a security, traded options are traded on the stock exchange, but the trades are matched using HKATS, the Hong Kong Futures Automated Trading System. Once you have a matched options trade, traded options trade, that's passed on to DCAS, the Derivative Clearing and Settlement System for clearing and settlement, and it's the options clearinghouse that will get involved. The last stage with an option is the exercise of an option, and the exercise instruction goes into DCAS, which triggers the underlying asset trade, which is cleared and settled in CCAS. Now, the actual clearing and settlement process that is carried out in CCAS by the Stock Securities Clearinghouse. During trading day T, we have the trade. Then T+1, the brokers receive their final clearing statements, having received provisional clearing statements the day before. Now, the continuous net settlement system is operated by the Securities Clearinghouse, which offsets stock transactions in the same security on the same day, resulting in one net stock position for that trading day. Through novation, the Securities Clearinghouse guarantees both sides of the trade. What does that mean? It means that we have a clearing participant for the buyer, a clearing participant for the seller, and in the middle, we have the clearinghouse, the Securities Clearing Corporation. The clearinghouse will buy from the seller and will sell to the buyer, thereby guaranteeing both sides of the trade. T+2 is settlement. So trading day T is the trade. T+2 is settlement, settled by electronic debit and credit. This is Hong Kong's clearing and settlement rules. T+3, if a selling clearing participant doesn't have enough stock in its account, then it will be subject to compulsory buy-in, where the clearinghouse will go into the markets and buy at whatever price they can get to replenish the clearing participant's stock account. Section 3, transaction costs in stock trading. Now, broadly, you have brokerage commission, and there is no minimum in Hong Kong. Then stock exchange transaction costs. Stock exchange collects two levies, the transaction levy and the investor compensation levy, and those are collected on behalf of the Securities and Futures Commission. However, the investor compensation levy has been suspended since December 2005. The trading fee and the trading tariff are collected for the stock exchange itself, and the Securities Clearing Corporation receives a clearing and settlement fee. The percentages are listed there. It's unlikely the percentages are going to be examined. Unlike the stamp duties, please be aware, stamp duty is 0.1% on both the purchase and the sale. And that goes to the government. Transfer deed stamp duty, $5 charged to the seller. And finally, the transfer fee, $2.50 per share certificate. That goes to the share registrar. You will see right at the top of page 8, we note transaction costs associated with the stock trading payable to the brokerage house. That was 3.1. Share registrars, that was my last transfer fee, the stock exchange and the government. Section 4, trading records management. This is fairly straightforward. It's administrative procedures. Please be aware of internal control procedures and code of conduct requirements as listed. They can be examined, but there's nothing technically difficult there. The internal audit under section 4.2, this is stipulated in the internal control guidelines, and a firm operating a brokerage firm required to have a clear audit policy, ensuring that the internal audit function reports directly to management. There are clear terms of reference. Relevant staff are adequately trained with sufficient technical knowledge, and the audit results and findings are adequately recorded so that problems and risks are highlighted and resolved. Conduct of business, we had, this is a repeat really from section 4. Section 5 looks at the 9 principles that are addressed in the SFC's code of conduct. Be aware that if you breach the code of conduct, it's not law, so you're not breaking the law, but you can jeopardize your license. The SFC could suspend or even revoke your license if you breach their code of conduct. Section 6 looks at risk management. Firms must have appropriate effective risk management policies and procedures, and they cover 4 areas. Credit risk, that is the risk of losing money because a client or counterparty defaults. Market risk is the risk of losing money because the market goes against you, depending on the position you've taken. Liquidity risk is the risk that you're going to lose money or lose value because you cannot sell in the market because there's not enough buyers, or if you do, you're going to make a material loss. And operational risk is the risk of losing money from fraud, errors, omissions, and other compliance matters. The last section in topic 5 of paper 8 covers technology. With regard to internet securities trading, we're told internet trading provides investors with efficient, flexible means of trading, and the OTP system does allow internet trading of securities. Online financial information, we're told some of the largest electronic information providers allow access to their data via the internet. I'm sure you're aware of this, and we list some of the services that they provide. What has been the impact of technology? It's brought rapid changes to financial markets. Resulting changes include availability of vast amounts of up-to-date information, online securities trading, faster, more efficient execution and settlement, access to global marketplace, prompt paperless trading, and a wider choice of investment products for investors. Well, there's a typical list of points that could pop up in an exam question, so I would be aware of them. The last point we're going to cover is with regard to high frequency trading. And it's where computers are able to implement complex automatic trading strategies. Common features of these sophisticated technological tools: algorithmic quantitative approaches executed by proprietary trading firms. This is not on behalf of clients. The algorithmic trading is for the firms themselves. High order and transaction daily turnover, and very few, if any, we're told, overnight positions are held. Well, that brings us to the end of topic 5. As ever, the best way to make sure you remember the material that has been covered is to practice questions. And those questions, as I've said, can be found on Examinator.online.